Sure. Yeah, you're good.
Okay, good deal. So I always like Aaron going first because uh, his grain outlook has a pretty large impact on cattle prices, especially feeder cattle prices, and so it has a bigger impact on feeder cattle prices than cattle have on corn. So it's always good to have that right before looking at the beef side of things. Just in quick, right now everybody's profitable. It doesn't matter if you're in the cow calf business or if you're feeding cattle, and everybody in between. They're making money right now, which is a good thing. So it may not be as good as 2014 and 2015 as far as prices are concerned, but when everybody's making money, most people aren't too sad about it. Uh, Prices are holding pretty strong so far through the summer. I expect those prices to hold a little bit longer before we see our seasonal fall decline. And then I'm going to talk about a few favorable opportunities at the end of the presentation, talking about adding some weight to animals or buying some animals and growing them for 120, 150 days. Uh, we we've had a very abnormal year from the standpoint of finished cattle prices. Not totally abnormal, but the timing was a little off. And the expectation was, if you look back into that solid blue line, which represents 2017, and you look back towards the end of March and 1st of April, where we got to about 130, I would say most people in the industry probably thought that was going to be our spring peak. But we ended up having really strong demand and lighter cattle weights, and that further spurred the market up into the 144, 145 range into May. And since then, we fell off, and we've been trading around the 117 mark the past few weeks. We did jump back up to 119, but we've been trading there on the live cattle market pretty steady. Now, what happened earlier this week, Monday, the finished cattle market on the futures market plummeted, and I don't know how that's going to end up impacting the cash price this week. I really don't think it's going to have an effect. It may pull cash prices down $1 or so, but cash prices haven't always been following futures. A lot of times futures has been having to catch back up to cash prices. So we'll have to wait and see what that's going to happen there. But the thing is if 117 ends up being our summer low, what we would traditionally see is about a 13% increase from the summer low to the fall high, which would end up putting us back at 130. And I really think it's going to be difficult for us to get back to 130 by the end of November, which is the time period where we'd normally see those finished cattle prices bounce back. And the reason why this is so important, I realize we probably have a few people that are feeding cattle in the state. Actually, we have several people that feed cattle, whether that be in Kansas, Nebraska, Iowa. We've got several people that are feeding cattle. But, it's going to be really, really tough to get back to 130 on the finished cattle market come November, December. If we end up dropping a little lower, if we end up at 115, 114 on the live cow market here in the next couple of weeks, well, then that would indicate that we might only get up to 127, 128. But I'm projecting maybe a 125 for that November, December time period for what we're looking at. The lightweight calf market has held really, really strong so far this year. Normally peaks during the March, April time period again. But it kept going up into June. We've had very, very strong demand. Feeder cattle prices have been strong, so their calf prices have been strong. But it all goes into the fact that demand for beef has been very strong, and the consumer has really desired that product. There's a whole story with this that would take us all the way back into 2014 and 2015, really, that leads up to where we are and why we are where we are in the live cattle market and the feeder cattle market. But we won't take the time right now to discuss that because we probably did that in the last marketing meeting in June. And so, but the thing of it is the market has moved through some turbulent times, I will say, and the market has done several things that we hadn't seen happen before, and that included taking cattle to extremely heavy weights in 2015, whereas in 2016 we started moving them out at a rapid pace out of the feedlot because the packer was making a lot of money, and the feedlot noticed that it was more profitable for them to go up. The cattle that were on feed were losing money, and it was actually going to be more profitable to buy new cattle and get rid of the cattle they had. So that ended up cattle moving out very quickly. Here, that's just 7 to 8 weight prices, but a very steady summer price, very seasonal as far as feeder cattle prices are concerned. The lightweight calf prices has been a little bit unseasonal, but we're going to start seeing that fall decline on those 5 to 6 weights. I don't think we're going to see 5 to 6 weight prices get as low as they were last October and last November, but we definitely will see those prices decline, and I'll give you some indication that towards the end on what I think is going to happen, where they're going to be. If you're in the 5 to 6 weight selling range, or if you're in the 7, 8, 9 weight selling range, it's pretty interesting. We've seen a lot of 8 to 9 weight cattle sell the past week. I think we sold over 100 loads out of the state last week, and it didn't matter if you had 8 weights or 9 weights. The price was pretty steady across all of them. The feedlots are looking for cattle. We're placing a lot, but they're looking for cattle. So the real story really comes into the slaughter. This has been the past 6 months. This has been pretty evident that slaughter has been key. But heifer slaughter's up 10.6% so far this year, which is a big number. It's a big number. But if you look at it relative to previous years, I'm not talking about last year or the year before. If you look at it in previous years, we're still in a slow herd expansion mode. People are still retaining some heifers. Tennesseans aren't really retaining a whole lot of animals. We hadn't followed the same trends as everybody else, and a lot of that has to do with the climate of our condition. Mostly small producers. A lot of times we keep the same number of cows and calves. If we have 75 cows, well, that's what we have regardless. If it gets a little dry, we just buy a little more feed, and if the years are really good, we just roll more hay. We don't buy more animals or keep more animals based off of those things. We just know we have a certain grass base, and we try to utilize all of it. But 10.6% is a huge increase in heifer slaughter, and come next year, that percentage won't be so high relative to this year. But it will speak volumes as far as what we're looking at and that herd expansion mode that we're looking at for a cattle cycle. The big note here is that dress weights are down. We had several weeks where they were 20 to 30 pounds below a year ago. They're starting to ratchet back up, but we've had very, very good feeding conditions in most of the country where cattle feeding is. The temperatures have been actually pretty good. The climate's been very good for feeding cattle, and we're trying to move a lot of animals, and they can't always get them all moved as quickly as they want to be moved, and so that's put cattle on feed just a touch longer than where they were earlier in the year, but not as long as they were last year. Steer slaughter up 3.5% so far year to date. About on par with what we would expect given the number of cows, the increase in cattle inventory last year or at the first of this year. So similarly, dressed weights on steers is below year-ago levels. So what we've got more animals. When you have more cows, you're going to have more calves. More animals are going to go into the feedlot. So we expect beef production to increase because we have more animals in the feedlot. Well, at the same time, when we reduce those finished weights, each animal doesn't have as large an impact on beef production as it did the previous year because we have a lot less beef per animal coming off those animals. Beef cow slaughter is up 10.4% year to date, so that's more beef production coming into the marketplace. In 2012, when we had a huge sell-off of cows because of the drought, we ended up with one of the youngest cattle herds probably that we've seen in several decades, because people sold off a lot of old, poor producing cows, and that resulted in a bunch of younger animals. And now we're getting to that point. That was 5 years ago. Some of those animals are starting to get a little older, and those animals are going to start coming out of fields. And when prices don't look as favorable, we're gonna market more cows. This is strictly beef cow. This doesn't include any dairy cow inventory. So with that, we compare beef cow and heifer slaughter up 10%, and steer slaughter up nearly 4%, and our beef production is only up 4.4% so far year to date. The good thing is we've had a very strong international market, and which has helped support getting rid of this beef. Similarly, pork production's up 2.8%. There's a lot of meat out there. We've got a lot of meat out there. Broiler production up about a little over 1%. So it's key to know that we've got a lot of beef being produced, we got a lot of pork being produced, we got a lot of poultry being produced, and somebody's got to eat it. So it's either going to be up to us to eat it in the United States, or we're going to have to be able to move it to other countries. And don't forget that we're also importing certain products, and that leads to that consumption that that per capita consumption that we have in this country. So in reality, the per capita meat availability is not much different than a year ago, because exports have been pretty strong. We're talking about maybe 2 more pounds of beef per person in a year in 2017 as opposed to 2016, and there's a little more pork on the market, a little more poultry. So not a huge increase that each person would have to eat. So here's probably the biggest stories right here, and there's still, when you're talking about international markets and international trade, everybody's always for exports, but then they say, well, I don't want to import anything. Well, if you want to be able to export, well, you better import some things, because those other countries, they want to move product too, regardless of what that product is. We produce a type of beef that nobody else in the world produces, and that's an advantage of ours. And so we're able to move very, very high quality product to countries that desire a corn finished beef product. And largely what we import is lean grinding beef. And so, with China coming into play, they have a growing middle class, which means they're eating more meat, and they're transitioning. They've always primarily been a pork consuming nation. They're moving to some beef items, and that's going to be a slow market to open. With whether it be talking about, their stipulations are animals under 30 months of age, which is no problem. That's not a struggle for us. They want to be able to know the origin of that animal, as far as the farm that it was produced on, that it was raised on, and the harvest facility. So where was it born and where was it harvested? Well, we can do that. There's a lot of cattle in this country that we can trace very easily. That's not an issue for that. The issue comes in with not using any type of growth promotant, whether that be an implant or that be a beta agonist or a feed additive. Those are 2 technologies that feedlots use very heavily, that return several dollars to the feedlot. There's going to have to be a significant price premium on beef that goes to China for a lot of our feedlots to transition from not using implants or beta agonist. So we'll see how that progresses. We do have feedlots that produce in that manner, which they're producing for markets such as the European Union, and we'll ramp that up slowly. But there definitely has to be a price premium, and so we're going to have to see how that market slowly develops. And we also know that China can be a little fickle on occasion, and they recently cut off imports from 6 facilities in Australia due to labeling issues, which is a good thing for us, because they do a lot of business with Australia, and because of these labeling issues, they've shut off 6 facilities and imports out of Australia. should be beneficial for us. We'll see how long that lasts. We shut down the Brazilian imports. Not really that big a factor in our market. We weren't importing a lot of beef, but what it came down to is 11% rejection rate of Brazilian imports versus the rest of the world that we were importing from was only a 1% rejection rate. So we'll see how that turns out. You know, I'm sure the people that were concerned about foot and mouth disease are happy about this. I don't know if there's a whole lot to worry about right now with foot and mouth disease, but we'll keep an eye on that. Even though JBS and rock the world, I guess, with their bribery and illegal ways of obtaining borrowed money to become the largest meat company in the world, it's amazing how well they bounced back. The Brazilian meat market has bounced back very strong following those bribery allegations. They're not only allegations, it's definite that it occurred, but they bounced back very strong. It probably helped our market in a short-term basis, and it may help us a little bit as some people don't like doing business with people that don't always tell the truth. Then we go into these, the big hot topic right now is NAFTA and the renegotiations of NAFTA. We do a lot of business with Canada and Mexico, and it's very key that we continue to do business with those folks. And so we'll have to wait and see how that plays out. But, you know, we do import several feeder cattle from Mexico, and some people would say that hurts our market, but in reality, it really helps our our cattle feeders. They're looking for more cattle. We don't produce enough cattle to fill up those lots, and so it's nice to have those animals come into the country from that standpoint. You know, a lot of people would say that type of beef is competing with the rest of the beef. Well, you have to think about the breed of animal. We know breed of animal does impact quality grade, and so a lot of those southern cattle end up not grading as well, so they end up being several select cattle in the cattle that come out of there versus most of us are trying to hit a choice market or higher, and so that's very key in what we're looking at. Some of those select animals really actually help us on not having to import as much grinding beef, because a lot of that select beef can end up being ground as opposed to being in the cuts of beef. Now, our government is going to have to get in a little bit of a hurry, I hope, on trying to get some of these trade agreements in the works and signed. Currently, Japan is an issue for us. The frozen beef business in Japan, we were under a 38.5% tariff for frozen beef. Well, we hit a mark. Japan imported so much frozen beef that starting August 1, we now are subject to a 50% tariff on frozen beef. Doesn't have anything to do with fresh beef. Fresh beef is still at 38.5% tariff. The problem that we run into is countries like Australia, who have a bilateral agreement with Japan. Their tariff is only 27.5% or so. So all of a sudden, our product, when you increase the price of importing our product by 12.5%, the U.S. product is more expensive, and that's going to end up in more imports from Australia. Thankfully, Australia was in terrible drought, and they're trying to rebuild that herd. They have started ramping back up their exports, but they're not to levels that we had seen 3 or 4 years ago. So that's going to be something that, if we don't get a bilateral agreement or some type of agreement with folks in Japan, iron out our situation in China, maybe improve our situation in South Korea. We need to improve our situation in North Korea too, huh? But that's a whole nother story. But we need to improve our situation with those people that we're doing business with, so that we can compete with these other other major beef producing markets. Imports, they had been below year-ago levels for about 6 or 7 months, but we kicked back up. A lot of beef coming out of New Zealand, and like I said, most of this is grinding beef. We have a strong demand for hamburger, and we need lean grinding beef. You know, when we have 72, 73% of our cattle grading choice, and then you add another 3 or 4% that are grading prime, we have a lot of high-quality beef. Now, you can see where we nearly exported. We were just shy of 300 million pounds in June that we exported, which when you compare it that we imported, 300 million pounds that we imported, and you compare that to the 240 million pounds that we exported, you say, well, we're not exporting as much beef as we're importing. But the huge difference is when you look at quantity basis, we're not exporting as much beef as we import, but we export a lot higher value of beef than what we import. I wish I had the value numbers at the top of my head right now, but I don't. But the export value of our beef is much higher. If you look at it from value side, we export a heck of a whole lot more beef than we import. And that's because we're exporting high-valued middle meats, so steak cuts that go into a lot of restaurants in other countries. And then we're also exporting, variety meats, liver, tripe, beef tongue, heart, all those things. Those all have different markets. You know, some of those things go to Egypt, some of those things go to Mexico, some of those things go to Japan. And when we can increase the value of an animal by essentially $200 to $250 a head through the export market, we're really adding value to the product that we have. So there's several opportunities that are going to be available due to the struggles in other countries. We just got to figure out how to get some meat moved. This is just strictly to show you that box beef prices have softened, but it's pretty typical this time of year for wholesale meat prices to soften during the dog days of summer. And we'll see those rebound as we move towards the holiday season in November and December. Aaron has already showed this. His implications were in the situation of corn and soybeans. But we have to remember that a lot of that country that he talked about being wheat country, there's a lot of cattle out there in the western parts of the Dakotas, in the eastern parts of Montana. Even the sand hills of Nebraska have been terribly impacted by this drought. And so there's a lot of cattle in those places. Going to see probably a lot of calves move early this year. The hay market. The hay market in that area, hay prices have increased tremendously, and it's not all because of drought. It's because there's been strong export. There's been strong export demand for high quality hay, and so those folks out there, they're having to pay up to get any kind of hay, and they're not going to be able to buy it all. So we're going to see a lot of calves that move early, and a lot of people are trying to salvage some of their cattle herd. What does that mean? That means a lot of cattle going on feed a little earlier, coming off feed a little earlier, which will impact the seasonality of prices to some degree, but not too much. Pasture conditions. This is a national number, so this covers all the regions, and the biggest part of that is because of the northern plains. Our pasture conditions in the southeast are very, very good. In my entire life, I can guarantee you this is the best pasture conditions I've seen at the beginning of August. In 30 years of lifetime, I couldn't name a year where we had better pasture conditions than what we have right now. The only thing that's hurt us is sometimes you couldn't get all your hay up because it kept raining in some situations. Cattle feeding is pretty cheap. There are a lot of people that put cattle on feed back in January and February because they didn't want to. The price of feeder cattle just wasn't good enough, and those guys made a lot of money by putting cattle on feed. It's pretty cheap to feed cattle right now. Is it the right decision to put put your calves in a feedlot? It's debatable. I think there are opportunities to still make money by feeding cattle. But the good thing is even if you don't want to feed your cattle, if Aaron can keep corn prices low, cattle feeders will be happy. If Aaron can make prices go higher, then corn producers will be happy. So it's a double-edged sword, and that's why you have a lot of those farmer feeders across the Midwest, because they either are going to sell it across the scale, or they're going to put it on, walk it across the scale. It's either going to go by truck or it's going to go by a four-legged animal. And if prices are low, they're going to put it through a four-legged animal. And if prices are high, they'll go ahead and move a lot of that product. So if prices on feed stay pretty low, we'll probably be in pretty good shape for feeder cattle prices as we move forward. Here's the November. I show the November futures price. And the purpose of this is to show that we have really, really good support at the 140 price level. I don't see anything that would indicate that feeder cattle prices will move below 140 at this time between now and November. Is there a little upside from where we closed yesterday at the 144, nearly the 145 mark? Yeah, there's a little upside potential, but we're pretty range bound between 140 and 152. So if we were to get up to 148, 149, Aaron mentioned using some futures alternatives to hedge a price. If you've got load lots, it might be advantageous to use the futures if we jump up to 148, 149. When you're looking at a 145 mark right now versus a 140, if it dropped to 140, it might cost you just as much to play in the game to try to hedge something as that loss would hit you. So right now, I wouldn't say make any moves, but if between now and the end of September something bounces up, it may be a good opportunity. Here's the March futures price. I think March cattle are undervalued right now on the futures market. I've thought this for a while, and I'm going to continue to think it. I really do believe as soon as that calendar turns over and you hit January 1, you're going to see these deferred contracts into 2018 bounce a little bit, and that's to the upside. If I'm wrong, you can tell me, you can call me and tell me I'm wrong, or the next time we have this meeting, you can tell me I'm wrong. But I really think we're undervalued. We'll see. There's still strong support around the 135 area. You can go all the way back to end of April and see where we were pretty strong there. So real quickly, looking at background and steers September to January, there's probably several people that are going to be weaning calves in the near future, and there's probably several people that are going to be looking to buy calves from the stocker cattle operation. So I've got 525 pound steers in September with an expected price of about 145. I think that's going to be pretty close. I think last week those same animals probably traded around 148. So between now and 1st September, I think those prices will decline a little more. Could be below 145. But I'm looking at I don't know why that says November. That should say January. I know exactly why it says November because I failed to update it. But this is January prices right here. So we're looking at 150 days or so, and just looking at 2 pounds of gain a day. I'm expecting a 825 pound steer to be around $1.40 come January, which ends up with a value of gain at 131. That is a very, very strong value of gain. That is extremely strong value of gain. And so what I did is, because that was so strong, I looked back and I said, well, what could we do for $1? What would the price be if we were looking for $1 value of gain? So we could end up selling that 825 pound steer for $1.29, and our value of gain would still be $1, $1 and a penny to be exact. But what that tells me is right now it looks like a prime time to be buying cattle and trying to put weight on them. And if you already own those calves, instead of selling them in October and November or whatever your plan was, backgrounding those calves and adding weight could be a really advantageous thing. Now, these prices I'm showing, this 140 is a load lot price. So the 145 is buying them as singles, and the 140 is selling them in a load lot. But even if all you can sell them is in groups of 10 or 15, you're not going to, there's $11 price range right there, and you're still a value gain over $1. And most people are going to have a cost of gain that's, depending on what you're using, it's going to end up being anywhere from 40 cents to, maybe 80 cents. You can do it more expensively, but you saw where the feedlot was putting it on for 75 cents, and they're completely grain based. So they're doing it for 75 cents, and even with 75 cents, that still leaves you a quarter of gain for every pound that you're putting on. So that's something to think about in the near term. Going a little farther out, November to April, looking at a November price on 525s at 139, and then a sale price at 138, which again, we're looking at a very, very strong expected value of gain at 136. I mean, these are astronomically high values of gain. And prices could go as low as 125 and you still have $1 value of gain, which is a very, very good number. $1 value of gain means you can play in this game. And I think it's something that producers should consider. I'll just throw that up there, and with that, Aaron, I'll open it up for any questions that we may have.